Welcome back to the fifth tax law module, Credits, Other Taxes, and Payments. The purpose of this module is to learn about the different types of tax credits, taxable income, other taxes, and tax payments. Other taxes will also be introduced, and we'll learn how refunds are determined or how tax owed is calculated. There are two types of credits: refundable credits reduce the amount of tax as close to zero as possible, and can reduce the tax liability to and below zero to provide additional money back to the taxpayer as part of their refund. Non-refundable credits can only reduce the tax liability to zero and do not provide money back as a refund. Let's begin with credits for kids. The child tax credit is a partially refundable credit worth up to $2,000 per qualifying child. The additional child tax credit is the refundable amount available for certain taxpayers with a tax liability too low to take advantage of the full non-refundable full credit. To receive the child tax credit and additional child tax credit, the child must be claimed as your dependent and must be under age 17 at the end of the tax year. As long as all the dependent's information is entered correctly, the tax software will automatically calculate the child tax credit and the additional child tax credit. If your dependent doesn't meet the rules for the child tax credit, are you just out of luck? Not quite. There's also the credit for other dependents. Unlike the child tax credit, the credit for other dependents is strictly non-refundable. It can reduce the tax liability by $500 for every dependent claimed on the return that does not qualify for the child tax credit. There are also credits available for those who are pursuing post-secondary education. Taxpayers who qualify for qualified education expenses can claim education credits for themselves, their spouse, or their dependents who are enrolled in an eligible post-secondary educational institution during the tax year. Generally, this applies to universities, colleges, or vocational schools. There are two other credits available to taxpayers to help them with their educational expenses. Those are the American Opportunities Credit, which is partially refundable, and the Lifetime Learning Credit, which is entirely non-refundable. Another credit known as the Retirement Savings Contribution Credit or the Savers Credit is a non-refundable credit for taxpayers who contribute to certain retirement plans like an IRA or an employer-sponsored plan. This Savers plan has a double benefit by encouraging retirement savings, gives a tax deduction and credit on the same money, and you can contribute to the credit up until the time you file your return. The final credit we're going to discuss is the Earned Income Tax Credit or the EITC. The Earned Income Tax Credit is a federal tax credit for low and moderate income individuals and families. It encourages and rewards work as well as offsets federal payroll and income taxes. The EITC is a refundable credit. So this means taxpayers who qualify can get a refund even if they have no filing requirement, they owe no tax, or had no income tax withheld. The amount of the Earned Income Tax Credit a taxpayer receives depends on three factors: your filing status, number of qualifying children on your tax return, and the top level of earned income. Recall the two types of income we've discussed in a previous module: unearned income, which is income received from retirement investments and other sources for which services are not performed, while earned income is income received for performing services such as working wages or self-employment income. For earned income tax purposes, only earned income is considered. How do taxpayers qualify for the Earned Income Tax Credit? There's a set of rules for everyone and a set of rules for taxpayers with one qualifying child or more and for taxpayers with no qualifying children. First, the rules for everyone. To qualify for the Earned Income Tax Credit, you must have a valid Social Security number and be a U.S. citizen or permanent resident. That means that taxpayers with an individual taxpayer identification number or an ITIN are not eligible, nor are married filing separately, as is anyone who can be a qualifying child of another taxpayer. The taxpayer's investment income must be at or below the investment income limit, plus income limits do apply. The rules for taxpayers with one or more qualifying children must meet the test for relationship, age, residency, and joint return. The qualifying child for the Earned Income Tax Credit must be under age 19 or under 24 if they're a student, or any age if they are totally and permanently disabled. The qualifying child for the Earned Income Tax Credit must be a U.S. citizen and have a Social Security number. They must also have lived with the taxpayer for more than half the year, and the child cannot file a joint return. Notice there is one difference between who can be a qualifying child and who can qualify someone for the Earned Income Tax Credit, and that is the support test. Even if someone is not a qualifying child because they provided more than half of their own support, they may still qualify the taxpayer for the Earned Income Tax Credit. For taxpayers without a qualifying child, they must be at least the age of 25 years of age, but under age 65, and they must have lived in the United States for more than half the year. You can find and consult with the Earned Income Tax Chart with all of the eligibility requirements in your Pub 4012 on page I-4. That's it now for credits. Let's talk about other taxes. These are not the usual income taxes, but other special taxes that can be added to the return in certain circumstances. Other taxes you may encounter include the self-employment tax, which is the Medicare and Social Security payments that taxpayers who are self-employed or independent contractors must pay. There's also the tax on early retirement distributions. This is if a taxpayer receives a distribution from their retirement account before age 59 and a half and does not qualify for an exception, they will have to pay income tax on the distribution and a 10% penalty. And the first-time home buyer's credit, which was a credit given to individuals and couples who purchased a home back in 2008. The credit must be paid back, and the taxpayer will receive a letter from the IRS that states the repayment terms and how much must be reported on their return. Once the total tax is figured, it's time to apply payments and refundable credits. Federal income tax withheld from W-2s and other income are payments. Refundable credits like the Earned Income Tax Credit and Additional Child Tax Credit are payments also. The refundable portion of the American Opportunities Credit will also appear here, as well as the Premium Tax Credit. The Premium Tax Credit is designed to help eligible taxpayers pay for health coverage. However, any taxpayer receiving the Premium Tax Credit needs to be served by an advanced level preparer, so be sure to return next year to learn more. All payments are added together and compared with the tax liability to yield either a refund or an amount owed to the government. Remember from Module 4, Form 1040 uses information about the taxpayer, their household, their income, and other life experiences to determine the tax they owe for the year and whether or not they will receive a refund or incur an amount owed. How are refunds or amounts owed determined? Well, we start with the taxable income minus adjustments to determine the adjusted gross income. The standard or itemized deduction and qualified business deduction is subtracted to determine the taxable income. Total tax is determined by the range of the taxable income found in the tax tables. Once the tax is determined, credits and other taxes are then applied, and prepayments such as the federal tax withheld or refundable credits are applied. If the prepayments are more than the tax, the client will have a refund. However, if the tax is more than the prepayments, there will be an amount owed. Thankfully, the software we use called TaxSlayer does most of the work for you. You will be trained on how to use and enter the information into TaxSlayer correctly, as well as using your Pub 4012 to be on hand to guide you. If the taxpayer is due a refund, they can opt for an electronic deposit into their checking or savings account. To complete the tax return, only the tax client and their spouse, if married filing joint, sign the return if paper filing, or Form 8879 if electronic filing. Volunteer preparers do not sign tax returns. Well, that's a wrap on credits, other taxes, and payments, and for our overall tax modules. Congratulations! You've made it to the end of Cash's Tax Law webinar. I hope you now have a strong foundation on which to build your tax prep knowledge during training. Please remember that these modules are available at any time for your review. As a reminder, Cash's volunteer training sessions are held in January. Go to the URL on the screen to register for trainings, learn more about volunteer resources, or to request information from our volunteer engagement associate. Share your feedback with the staff of the Cash Campaign of Maryland. We would love to hear from you with suggestions to improve our training materials.